Good morning. Welcome to Thursday's edition of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Rima. With me is Vivek, and it's very, very quiet on the benchmark indices. It's just blinking red and green on the Nifty and the Sensex. The problem is in the broader markets, the mid-cap index is down close to about 0.8%. The small-cap index is a cut of more than 1%. But thank God, we've got the banks which are holding up. The Nifty bank is the only sector which is currently up in the green, and that's got a gain of close to about 300 points. All the other sector, whether it's metals, real estate, auto, IT, all in the red.
Absolutely right. It's a news-heavy, handover that we received post, the one-day break that we've received. And like you mentioned, it's only the banks that have managed to hold out, especially banks with NBFC exposures. They are the ones that are actually gaining the most or that have the most beta. Look at names like AU Small Finance Bank, RBL Bank, Bandhan Bank, these banks with their MFI books. These are the ones that are doing very well in the session. All of them up close to 5%. The other set of stocks that are doing quite well are the NBFC pack. Remember, because the risk weighting as far as bank exposure or borrowing to NBFCs is concerned, that too has been significantly reduced. And on the back of that, have a look at L&T Finance, Aditya Birla Capital, M&M Financial Services, Chola. All of these stocks doing quite well. And the other set of stocks that are doing quite well are the MFI names and the small finance banks. So Credit Access Grameen, that stock is the top gainer when it comes to the NSE 500 index. Ujjivan Small Finance Bank, 5-Star Bills Finance, these are stocks that are doing quite well. But one sector that you've been focusing on since morning is the cable and wireless bank. One large entrant, and overnight, most of these stocks have taken a hit of close to 15 to 20%.
Indeed, big PED rating. KEI Industries opened with a cut of about 10%, but now it's down close to about 18%. So the sell-off is only deepen as the days progress. But these are the two big stories. Banks on the way up, NBFC banks, MFIs on the way up, and on the way down, you've got Ultratech Cement and the cable and wires stocks which are under pressure. And these two themes are dominating today's trading action. So let's address them. Abhishek is now joining in with more on banks, NBFCs, MFIs, and how RBI reducing the risk weight benefits these.
Well, to begin with, RBI has reduced the risk weight requirement for certain loans that are being given by banks to certain categories like MFI, NBFCs, etc. So bank loan growth to NBFC, which was growing at a rapid pace of 30% plus in November of last year, that is November of 2023. Prior to that, it was growing at 30%, and that's when the brakes were put on. So RBI had increased the risk weight assets at that point of time for loans that banks gave to NBFC various segments. So out of that few segments, the risk weight assets, that requirement has been lowered down because the loan growth, which was around 30% plus at that point of time, has now gone down to 7% YOY growth as per December data of RBI. So they have restored a risk weight asset requirement for some of these segments like loans to microfinance segment. The risk weight assets have been reduced by 25% with respect to requirement over there. And bank loans to NBFC over there also, the risk weight assets have been lowered by 25%. So what this means is that effectively the cost of funds that the other lenders borrow from banks, that will see a marginal tape off given the fact that risk weight requirements have come down. So IIFL Securities has written a note. They say that 7 to 170 basis point CET1 benefit they see for lenders, especially banks. So higher benefit is for Bandhan Bank, Bank of Baroda, Ujjivan and Indus Bank. And if you take a look at the stock prices, they augur the same. Back to you.
Thank you so much, Abhishek, for joining us and giving us a sense of the entire move that benefits the BFSI space. Well, the other set of stocks that are in focus are the cable and wiring companies. Remember, Ultratech Cement has planned to enter the cable and wire segment. Upasana is here with more details and the kind of sell-off that these companies have seen today.
Well, cables and wire segment is under pressure today as the street fears the competitive pressure with the entry of Ultratech's Cement foray into the cables and wire segment. Now, Ultratech plans to enter cables and wire segment with an investment of 1,800 crore over the period of 2 years, and the company aims to meet the growing demand for wires and cables across various sectors. Now, cable and wire industry has witnessed a CAGR of nearly about 13% between FY19 to FY24. And with the entry of Ultratech, this may intensify competition for the existing large players. Now, if we look at the FY24 market share of the top players, Polycab stands at 26%, KEI at 12%, and Havells around 11%. Now, brokerages like HSBC is of the view that this is likely to have a material impact on the growth and margin trajectory beyond FY27 for these players, and it has lowered the target price of the major players from 7 to about 23%. Smallest cut for Havells, but similar cuts for cables and wire names like Polycab and KEI. Now, if we come to Havells, the HSBC has a buy rating on the stock, and the target price is cut by nearly about 6.5% at 1,730 per share. Polycab, the brokerage has a buy rating, and target price is cut as high as 20% to 6,250 per share. KEI, it has a hold rating, and target price is cut by 23% to 3,450. And lastly, RR Kabel, it has given a buy rating with a target price of 1,260. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other B2C players like Finolex and Havells, and it has preferred Polycab as one of the key picks in the segment. Now, Morgan Stanley says that this has come as a big of a surprise, but it foresees no concern going forward for these companies. So all in all, cables and wires segment is under focus, and Street fears high competitive pressures with the entry of Ultratech Cement into the space.
The Street fears, Upasana, but the management so far at least seem to be holding the faith, because we chatted with KEI Industries earlier today, and they believe that the cables and wires industries can accommodate another large player, and it will take them at least 3 years to start production and then another 3 to 4 years to start building the brand, and therefore they don't think the entry is going to disrupt the industry anytime soon. Listen in to Mr. Anil Gupta of KEI Industries.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them. There will be no problem in margin expansions, because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. There is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and I mean our growth trajectory will remain the same.
Well, that was the management of KEI Industries saying and remaining confident that they don't need to reduce any capex plans going forward. But we'll now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. Well, let's now shift our focus to the commodity space. Manisha joins in, and today you're focusing on copper, right?
Well, yes, we are, Vivek, and that is because the copper prices have been very, very volatile. We've seen prices gain up by 2% on Tuesday night, and yesterday there was some profit taking. So for this week, now we are in the negative by nearly 2%. For the month, we are still 7% on the higher side. And when you look at this year, copper is one of the better performing metals there with nearly 13% of gains. Well, the latest volatility comes in after US has ordered investigation into potential tariffs when it comes to copper imports within the country. Well, when you look at the US markets itself, US imports nearly 45% of its copper needs, and much of that really comes in from China and various American states there. When you look at the copper prices, there has been support also because of the demand coming in from conventional sectors, and then electrification, military and construction as well. So everywhere that you look, the markets seem to be really forecasting that going forward in the next 4 or 5 years, you could be looking at copper deficit growing in the international markets there. Importantly, it is about Chile, Canada and Peru, which account for nearly 90% of refined copper and mining into the international worlds. China's investment also in Congo seems to be increasing. So China is in a very strong state. If you look at smelters as a number, there are more than dozens that China has vis-a-vis 2 that US has. So clearly, this is to ensure that the dominance that China has and various other countries can be brought down. But at this point in time, even as you are looking at various investments coming into these countries, China's Congo investments are much on the higher side, and Congo, by the way, is the second largest copper miner at this point in time. So there's a lot moving in the international markets right now, and how the tariffs impact, and if the tariffs do come in, how they impact copper availability is something that the street is looking for. At this point in time, we've seen some buying come back into the Asian and the European markets.
Thank you very much, Manisha, for that. We'll get into a break. Before that, here is a small programming note for all our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. The prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now. Submit your entry for SME Champion Awards Season 2. Welcome back. Let's talk about the market technicals and where we are headed, because the sell-off in the mid-cap space is accelerating. The mid-cap index is now down more than 500 points. So it's a bit worrying. Shivangi Sarda from Motilal Oswal Financial Services is now joining in. Shivangi, it just looks like there is banks and then the rest of the market which is under pressure. What have you made of today's trading session? The strength in the banking index, does it have more legs to carry on from here? Because after the gap up, it's not that it continues to build on the strength. And what about the rest of the market? What is the index telling you?
Very good morning, Rima. Thank you for having me. So we've seen that absolutely rightly said that banking index is one side of the market and the rest of the market is trying to pull it down, especially IT, which has dented the entire market. Now, coming to Nifty first, we've seen that, after the slightly negative opening, we've seen that there has been some sort of a range-bound move. Now, Nifty index has got stuck within a very narrow range from the last 3 trading sessions, which is making the option premiums quite sticky at these levels. India VIX has cooled off, which is kind of creating some sort of lackluster move within a band here for Nifty. But the good part is there is a base formation that the Nifty index has been respecting. Now, talking about levels, we are expecting a strong support at 22,250 marks. But for the expiry point of view, which is the monthly expiry, we could expect some volatile swings in the last hour. So 22,250 would be an important support to watch out for the upside levels of 22,800 marks. So upside is slightly capped because of the call writers, which are still yet to unwind their position for the fresh leg of rally. Now, talking about Bank Nifty, we have seen outperformance here. Clearly, NBFCs are also supporting and contributing majorly from the last few weeks to this index. Now, the smaller banking names, which were earlier showing interest, at the start of the week, have now again started to pick up, especially some of the PSU names. So these stocks will be on radar, but Bank Nifty is comparatively better placed than Nifty. So we could go for a bullish stance in Bank Nifty for the next levels of around 49,500 with a support of 48,500 zones.
Thanks, Shivangi, for your index level views. Any individual stocks you're liking or you feel can be shorts at the current point of time?
Absolutely. So first on my radar is Bajaj Finance. So we've seen that this stock has come out of its cluster zone And 8,500 earlier was the level which the stock was not able to surpass. So now clearly there is a pole and flag pattern formation breakout on the daily frame. Now stock has been excellently respecting its key exponential moving averages on daily frame, and even on the month-on-month basis, we've seen follow-up is quite strong after the breakout. So overall, stock is quite well placed. There has been long built up in this one consistently in this entire series, and rollover is also quite positive for the next series that we welcome. So, recommending a buy here with a target of 9,050 levels with a support of 8,500 levels. Now, the second pick on my radar is SRF. This stock has been witnessing a good short covering move, and after the softness of the last 15 trading sessions, we are seeing buying interest emerge here again. Now, the dent wasn't so much, so there has been a pullback move from the exactly retracement level, which makes it quite positive here. Now, there is a good potential upside for this one with a good amount of call unwinding happening. So recommending a buy here with a target of 2980 levels and a stop of 2790.
Thank you so much, Shwangi. SRF, recall, had an analyst meet recently and a whole host of brokerages have come back quite positive. But as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back to Trading Hour. Well, the sell-off as far as the broader end of the markets continues to accelerate. The small cap index is now down almost 1.6%. The Nifty continues to trade very flat, but with a slightly negative bias. Manish Jain, head of fund management from Centrum, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Manish. Would you at this point of time have a look at any of the cable and wiring companies? All of them are now cheaper by 15 to 20% since the start of the day.
Yeah, this whole carnage, if I may use that term, in the last 1.5 months has been pretty unrelenting. And it's not just about one sector or the other, but if you do a very careful bottom-up sort of an analysis, then what I think you'll realize is that across sectors today, and specifically more so in the small cap genre, you will find a phenomenal number of companies that have all corrected anywhere between 30 to 40, maybe in some cases 50%, where the dent in earnings has not really been very significant. These have all now come down into what you call basically as a value zone, where you have anywhere between 10 to 20 P multiple on a 1 year forward basis for companies that you're looking at, still confident about 20% plus sort of earnings growth from that perspective. So my sense over here is that this is a market which is not meant for panic. This is a market which is not meant to sit on the sidelines, but we are reaching a point where we are almost at the bottom end of the whole bear rally, and the turnaround in my view is just around the corner. So take advantage of that situation and actually put in more money where your conviction is.
Manish, so incrementally, where will you be allocating funds?
Like I said, I wouldn't look at it more from a top-down perspective, but more have a bottom-up approach. There are sectors where we've seen a very significant amount of correction, where we are, at least as a fund house, deploying our money. There is the NBFC space, which looks very interesting at this juncture. There are hospitals, there is hotels, which are again looking very, very interesting. Manufacturing companies, selectively discretionary consumption companies, retail companies. So in that genre, in that basket. And if you have more of a value orientation at this juncture, looking at a large capish sort of a portfolio, then maybe large cap banks also are not very bad at this point in time.
Manish, sorry, just to get the view on Havells, KEI, Finolex, if someone has a position, an investment in these stocks, what is the advice?
So the sector looks interesting. These are good quality companies, great management, and all of them, like we discussed at the beginning of this call, they have kind of corrected fairly significantly from the peak. But from a 3-year perspective, the outlook kind of looks absolutely intact. So I would actually hold on to my positions, if not top it up.
Understood. So you don't mind actually adding on to some of these names. So what do you do with a name like Ultratech or companies that have significant capex, especially in fast-growing sectors? Is that would you buy the dip over there as well?
Cement at this moment, probably not, because there are more interesting ideas that are available in the market in the sectors that I outlined earlier, where the risk reward is much more favorably inclined, where the stocks have gone down in a value zone. So if you look at the whole market very carefully, and if you scan the whole universe fairly carefully, I think the realization that you set is that there is a lot of money to be made at this juncture, provided we have a little bit of gut, a little bit of gumption, a little bit of conviction to back ourselves. Then there are stocks that are available at now in the small cap space, 10, 12 PE multiple, looking at 20 plus earnings growth at a peg of 0.5. I wouldn't necessarily want to bet incrementally big on cement sector at this juncture. Probably not, no.
Do you want to tell us some of these small mid caps which are trading at 10, 20 times PE?
So like I said, there are NBFCs that look very interesting. There are hospitals which are looking very, very interesting. There are hospitality stocks, particularly in the hotel space, which are looking very, very interesting. Some of these South-based real estate companies which are looking fairly interesting. So small and micro cap is a space where I'll go at this juncture, because the time to be defensive, in my view, is kind of completely over. Right? That defensive portfolio is kind of over. I think Q3 earnings was the bottom of it. Earnings growth will improve. There is a rate cut that has happened. I think the market stabilization is coming through now, and you will see Q1 onwards market starting to rally back again. So I think I'll prepare the portfolio with that orientation in mind.
Manish, bold call. You're calling for the bottom as far as Q3 was concerned. Now, within financials, you said you do have a preference for NBFCs. Now, one space that's seen quite a bit of selling pressure has been the MFI space. Is that a space that you like? Would you add, positions over there? And any sectors that you would like to avoid, even at this point of time, post-correction?
Yeah, probably I wouldn't incrementally look at betting big on, say, something like a pharma. That's one sector that I'll probably avoid a little bit. I'll be a little selective as far as my calls on autos are concerned, for example. Again, wouldn't be betting big as a basket over here. But as far as NBFC and banks are concerned, see, the call is fairly simple, which is that the whole asset quality cycle that we've seen emerging out in the last 2 odd quarters or thereabouts, I think is by and large now looking like it's going to be over. Probably by Q4, you should see the bottom end of it. And Q1 onwards, you should start seeing improvement in asset quality coming through. So from that perspective, if you have, as an investor, 6 months sort of a patience to weather out the storm, I think it's a great time to build positions in the NBFC and in the large cap banking space, where we do expect a little bit of traction to come through in consumption and consequently in the overall credit growth because of the RBI rate cut. I don't think one is going to be enough. There are going to be probably at least, if not 2, then at least one more rate cut, which is going to happen. So because of that, the sector should get a little bit of a traction with the asset quality bottoming out. I think it's a great time to actually look at the sector. It's a little contra call, but I think should work.
And in real estate, it's only the South-based real estate companies which look interesting to you.
Yeah, because,
why is that? What are the tailwinds?
See, the larger developers tend to be a little more expensive from a risk-reward perspective, right? The valuation gap is massive. But the smaller developers, especially the South ones, have not really had a great quarter this time. So the correction has been fairly intense over there. So from a valuation perspective, purely valuation perspective, the risk-reward tends to be much better over there.
Manish, 2 sectors that have borne the brunt of selling pressure due to tariff-related concerns. Number one has been auto, also on the back of a likely disruptor coming in. How do you view auto at the current levels? And pharma, you said that you'll stay away, but post-April 1, will you take a relook at the sector?
See, when you look at the whole tariff war situation with the US, and there's some little bit of analysis that we've kind of done in that space, there are 3 sectors which are going to get burnt the most if and when that incremental tariffs from US happen. Number 1 is going to be pharma. Number 2 is going to be chemicals. And the biggest, I think, is going to be textiles, right? So in that order. Now, from that perspective, and given the rally we have had in pharma, given the valuations where they are from a 2-year perspective, I think pharma is probably best avoided at this juncture, especially, like I said, when there are so many opportunities which are available in the market, not necessary to lean on pharma at this juncture. So that's how I am looking at things. But other than that, I think autos, not as a basket. See, more from a disruption perspective. When you look at EV, I think it's going to be a long drawn battle, and I'm assuming you're referring to the entry of Tesla eventually at certain point of time. Then the point is EVs are a long way to go as far as disruption is concerned for a meaningful contribution to the bottom line perspective. Infrastructure still kind of continues to be a fairly bit of a challenge. EV is still never going to be your first car that you buy. It's always going to be a second, maybe third car that you'll buy, because even in a city like Bombay, Delhi, charging infra is a huge problem. But having said that, if you get an interesting bet at this juncture, especially in the four-wheeler space, maybe not two-wheelers, I wouldn't really mind having a look at it with something that can be a little bit of a leaning towards, say, entry-level cars, maybe something that could be a leaning towards, the value segment.
Right.
The people who are salaried 12 lakhs of income and less, which can be target audience for that, I think that can be a great bet to have, especially given that the pipeline inventory has all cleared out in this current quarter.
Thank you so much, Manish, for joining us and giving us your views on the markets as well as your fundamental picks, in terms of sectors especially. Time now for a short break. The management of Ceigall India joins us to discuss their future outlook and more.
Gross NPA of the lenders increased by more than 32% in H2 FY24 versus H1 FY24. This compares to a decline of 32.5% in H2 FY23 when compared to H1 FY23. We had highlighted in May of 2024 that rural market has come under stress. Q1 FY25 showed further deterioration in their asset quality. So from May of 2024 to now, most of the lenders have given negative returns versus positive return that you are seeing on Nifty.
But onto our series of year-enders, and we are putting the spotlight today on the microfinance sector, and it witnessed pain in this year, and that is expected to continue in 2025 as well.
Welcome back to Trading Hour. Well, Ceigall India is in focus as the company achieved financial closure for two of its projects in Uttar Pradesh. Bhagat Singh, the Group CFO at Ceigall India, joins us now to discuss this as well as the outlook for FY26. Thank you so much, Mr. Singh, for joining us. First up, give us a sense of what exactly the financial closure means in terms of execution for the Ayodhya bypass project that you have on board. When do collections actually kick in for this particular project? And what kind of margins can we expect from you in this particular project?
Good morning. Thank you for inviting us for this session. So we are pleased to inform you that the company has achieved the financial closure of both our Ayodhya HAM projects. So precisely, we are going to construct the two HAM projects measuring 67.57 kilometers in the UP region, Ayodhya. And we are expecting that the work will start precisely. We are going to receive the appointed date for both the HAM projects in the month of March or maximum by April 25. And this is going to create a very positive impact, not only for the Ceigall India Limited, but yes, for the overall infrastructure development of the Uttar Pradesh. By securing this contract, Ceigall India Limited has proved its credentials to be one of the key players for executing the large size EPC projects for India.
Understood that. Mr. Singh, the other thing which we want to ask you, especially in terms of EBITDA margins. Q3, when we saw EBITDA margins, there was a significant dip. Give us a sense in terms of upcoming projects. What are the projects where you're getting paid for execution? What are the projects where you are actually performing the O&M part of the entire road project? So we understand that O&M margins will be higher. And going forward, what is the kind of steady state EBITDA margins we can expect?
Fine. Before that, I need to make you understand what is a HAM project precisely. In the HAM projects, 40% of the payment you receive during the construction period and remaining 60% is payable to the concessionaire in the coming 15 years in the form of annuity. And the entire O&M of the project will be done by the concessionaire itself for the rest of the 15 years. Now, coming to your point on EBITDA, I would like to once again clarify that the company EBITDA margin is divided into two parts. One is pure EPC margin, which the company derived by executing the road projects, pure EPC work, be it metro, be it a road project. So that the company has given a guidance in our last earning calls also that we are maintaining between 11.5 to 12.5. That is for sure. Now, over and above that, the other incomes which contribute towards the further elevation of EBITDA from pure EPC to the total EBITDA, that is FDR income, royalty income, bonus and claim. Now, all these incomes are irregular income and it's booked by the company as and when received, because claims are received whenever it is sanctioned and approved paid by the authority. Bonus is received when you complete the work beforehand from the authority. Other income is received when you have the FDR. Now, in each and every quarter, these four types of incomes are not regular and is received as and when awarded by the authority. As far as FDR income is concerned, we are expecting FDR income to decline and PBT to be increased further, because post-listing and post the AA rating of the company has been able to release its FDR from the banks and is utilizing the released FDR from the banks for further supporting its NWC position and reduction of a debt. On account of a reduction of a debt, the company is able to save a substantial amount of its financial cost, which is contributing towards the further improvement in the PBT. So the margin we are expecting to continue further in the time to come, but we need to understand the bifurcation of the total EBITDA into pure EBITDA and the other income. And as far as the future outlook is concerned, I would like to further emphasize the fact that the company is working for the further modernization and a growth with a massive vision of 5 to 7 years. We are not basically a road company or a highway company. We are a infrastructure company having a diverse presence across more than 13 states in India, and our focus is not only towards road. As we speak, we have an order book of 13,000 crores with a good diversification into roads. We are into metro projects, we are into railways projects, we are also into tunneling. And going forward, our focus is also towards water and irrigation projects, solar projects, and that for a EPC. So we are towards a path of building a well-diversified order book.
We get that. Right, Mr. Singh. Mr. Singh, so currently at the end of Q3, where did your order book stand at? Q4, what has been the order inflow so far? End of FY25, where will the order book be? And FY26, what is the order prospect pipeline?
Our order as on Q3 last 31st December 2024 was 11,702 crores, which is reported. We have guided to the investors that we would be receiving, we are targeting to receive an order inflow of 5,000 crore in the financial year 24-25, against which we have already received order inflow approximately touching 4,500 crores. Remaining 500 is left, and so we are expecting that in the coming of the March, what we have already bidded contracts worth rupees 23,000 crores towards various authorities. So we are expecting that in the month of the March, if the bids get open and we turn out to be L1, we are expecting that this difference of 500 crores would be fully recovered. Going forward, in the times to come, we are expecting that we are targeting to get order inflow of 5 to 7,000 crores, precisely 1.25 times to 1.5 times of the turnover that we are going to execute every year, to keep our order book 3 to 4 times of the revenue book to bill ratio in the future.
Understood that. Now, talking about the order prospect pipeline, could you give us a sense, especially as far as NHAI ordering is concerned? It's been quite muted as far as FY25 is concerned. FY26, what are the kind of indications you're getting? Also, in terms of the bids that you actually go ahead and participate in, what is the win ratio that you typically have? So that will give us a sense of the order prospect as well as what is it that Ceigall can garner.
As far as the orders slow growth rate is concerned, so your point is correct, and I accept that point. But I think it is a matter of a concern for those companies which are heavily relying on the authority and they have a low order book as we speak. As far as Ceigall India is concerned, so as I mentioned, we have a good order book giving a visibility of next 2 to 3 years with high degree of certainty. So it is not a cause of a concern for Ceigall India, to be very precise. Going forward, as I mentioned, that we are targeting a good tendering and good bidding in the water and irrigation and solar segment, and more structure work. Metro station, we are expecting a good growth prospects, good tendering in the metro stations work also. So we are expecting a good order inflow across all these sectors in the financial year 25 to 26. As far as the winning ratio is concerned, so strike ratio in the past used to range from 10 to 20%, and we expect that in the future for FY 25-26, we will be able to maintain this strike ratio. But one thing I would like to specially mention here, the fact is, for us, what matter is getting an order with the envisaged EBITDA margin and providing a good, consistent return to the investor rather than maintaining a strike ratio.
Thank you so much, Mr. Singh, for joining us, giving us a sense of the order prospect pipeline, as well as the update as far as the financial closure for the Ayodhya bypass projects were concerned. Well, time now for a short break. We'll get you excerpts of our conversation with Vijay Jaipuria, who's the CEO of Delhi International Airport, on the other side.
Welcome back. Now, Terminal 1 of the Delhi International Airport is set to reopen by April of this year, post which Terminal 2 will shut down for further repairs and revamp. To know more about the expansion plan, CNBC-TV18's Abhimanyu Sharma caught up with Vijay Jaipuria, CEO of Delhi International Airport, and began by asking about the expansion strategy. Listen in.
As far as expansion strategy is concerned, I think we have just come out of a major expansion work, which has entailed the new Terminal 1, as well as the new runway and Eastern Cross Taxiway. So these are the three major elements. However, there are a lot of other elements also which are part of it, whether it is in terms of new parking stands in T1, T1 being equipped with 22 boarding bridges, and there are some parallel taxiways which actually reduces the taxiing time. So all these have been part of that expansion. Even in Terminal 3, we have put up additional check-in counters, as well as expanded the international to international transfer facility. So the next expansion is going to be immediately, the requirement is that of increasing the international capacity, because we have got in Terminal 3, there are 2 piers which are dedicated to international, and there are 2 piers which are dedicated to domestic. The plan is to convert one of the domestic piers into international, because international, our capacity is 20 million. We already have got a throughput of close to about 22 to 24 million, which we have started seeing. So that work should start sometime in April and will take about 4 to 5 months' time, which will increase our international capacity by 50%. In the meantime, since Terminal 1 is going to be fully operational, so the traffic from T2 as well as one of the piers in T3, we will shift them to T1, which has got enough capacity. And T2 then will be shut down for about 4 to 5 months, which will ensure that we have got a more modernized facility on the air side as well as on the terminal side. And the passenger, it will be then ready for better passenger experience.
The transition period which you just spoke of for shutting down and of reopening of terminals, of course, would be accompanied by an increase in passenger traffic, both for domestic as well as international routes. Now, of course, the Delhi International Airport and also the adjoining areas, other parts of the country are also witnessing a surge in air traffic. What kind of expansion plans or debt plans are there in the offing? Because we also understand there's also another airport coming up within Delhi NCR itself. Do you feel the opening of that airport is going to take some flights away from here, and possibly would it impact travel plans, especially for short distance flights? Because we do understand that Delhi NCR may be termed as a single region by space or by definition, but it's sprawling over hundreds of square kilometers. So do you think it would be a dampener as far as short routes are concerned?
Okay, you have asked 2 questions. One is that whether we will have capacity constraint. No, we will not have capacity constraint, because we are deconstraining any capacity constraint that we are currently facing. So by August, September, I will have international capacity, which is more than sufficient for the next 3 to 4 years' time. Even domestic capacity, which currently we are handling about 54 million passengers. So between T3, one pier, and T1 itself, I have 58 million capacity. T2 also will be shut only for about 5 months. So August, September, I will have another 15 million coming in. So I have headroom for growth in both the places. Now, talking about second airport, there is enough scope for second airport also to actually grow, because we have seen a fantastic increase in the aviation sector, and with the kind of positive influence from government, as well as the different kind of new incentives, whether it is Udan scheme, whether it is any of the other supporting schemes which are actually coming in. It is going to keep on growing, and there is enough for both the airports to actually operate in a region and give better passenger experience.
Speaking of tariffs, of course, there have been several tariff increases, many of them driven by commercial considerations, many of them driven by higher ATF prices. Do you feel there would be any cushion as far as prices are concerned moving ahead? Because we understand skyrocketing prices on several routes, and I'm not just talking about special occasions like Diwali or New Year, but even other points of time where we have witnessed these price increases. Do you feel such cross-subsidization is possibly going to decrease such kind of price shocks? Because we understand the market is highly unregulated with respect to airfare prices. But do you feel there would be any cushion for passengers in the times to come?
Only thing that I can assure you is that airport charges are not the ones which contribute to that, because airport charges are only about 1.5 to 2% of the total base airfare charges. So, and even with this increase, possibly that 1.5% will go to about 2.5%. So that is not the contributing factor. The rest depends on demand and supply situation, because it's a dynamic pricing. So as the supply keeps on increasing of number of seats, definitely there should be easing off of the airfares. But I am not an expert to comment on that.
Well, that was a very interesting conversation that our colleague Abhimanyu had with the management there at Delhi International Airport. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.